The first half of 2020 is thankfully behind us, and now it's all about the pace and extent of the recovery from recession. An update on our observations for the new financial year. The second half of last financial year was a devastating one, starting in January with the bushfires in full force amid catastrophic weather events, followed almost immediately by the global pandemic. As a result, our economy contracted 0.33% in the first quarter, but the contraction in Q2 will be at least 5%, the largest fall since World War II. The new quarter that we've just begun, however, should see a solid rebound, so the ability to reopen the economy and get businesses and employees back to work will be critical. The latest outbreak in Melbourne does threaten this process, with 20% of Australia's population suddenly back in lockdown, and may even risk a two-speed recovery for a period. So the outlook remains most uncertain. Despite these challenges and this latest blow to confidence, the markets have been full of optimism. In the June quarter, the Aussie dollar rose 12.5% to just over 69 cents, higher than pre-COVID levels in February, which is closely correlated to consumer confidence, as the chart shows. And similarly, the stock market put on 16% for our ASX 200 in Q2, albeit off a low base, and the Nasdaq index in the US is at a record high. In the case of stock prices, the opposing forces seem to be rapidly improving economic data for May and June, plus seemingly limitless fiscal and monetary support from governments and central banks all around the world, versus the ongoing threat of further COVID outbreaks and geopolitical tensions around trade wars and technology disputes. So that will all keep volatility bubbling along, even as the economic data improves here, in the US, and in China, which continues to look like a V-shaped recovery for our largest trading partner. Speaking of fiscal and monetary support, while the RBA kept rates on hold yesterday, as they probably will for another few years, the cumulative impact of their 3 rate cuts from last year and the 2 in March, with the fiscal stimulus packages, does seem to be working so far, with retail sales 4.5% higher today than pre-COVID and 6% higher year on year. So despite the obvious stress in labour markets, with official unemployment up to 7.1% and real unemployment probably closer to 11%, the stimulus measures have clearly helped. However, what this will all look like in 2 years' time has so many variables that simply no one knows. When will a vaccine be successfully trialled and made available? What will post-pandemic demand and investor appetite look like? What will the additional stimulus look like in size and nature? And how far will property prices dip in this new financial year, having fallen around 1% in the last quarter? As we suggested last month, capital city residential property fell 1.1% last quarter on average, but regional prices were up 0.3% for the same period. A taste of the changing landscape that we can expect post-COVID. And that's the market update from Bendigo Bank.